Okay, so you want to own a bank, take deposits from people, lend it out at a higher rate, pocket the difference. It's the oldest legal money machine ever built. And unlike a casino or an oil rig, a bank doesn't even need to own the product it sells. The product is money. And money is everywhere. So here's the strange part. In a single 2-month window in 2023, 3 of the 4 largest bank failures in American history happened back to back to back. $200 billion in assets gone. $110 billion gone. Then another one. 3 collapses all in 8 weeks. By the end of this video, you'll know exactly how that's possible, how a bank actually makes its money, why the model that looks bulletproof from the outside is the reason those banks collapsed from the inside, and what it takes to build one that doesn't. Banks come in 3 sizes, and they are completely different businesses. The smallest is a community bank. We're talking a single town, a few branch locations, maybe $500 million to $1 billion in total assets. To start one from scratch in the US, you need a minimum of $15 to $25 million in regulatory capital just to open the door. That's before a single employee, a single branch, a single desk chair. It's the price of permission. Mid-tier is a regional bank. Think $10 to $100 billion in total assets. You're not building that from scratch, you're acquiring it. Regional banks in the US typically change hands at 1 to 2 times their book value. So a bank with $2 billion in equity costs you $2 to $4 billion to buy. Then there's the top tier, JP Morgan Chase, $4 trillion in assets. You are not buying JP Morgan. What you can note is that JP Morgan posted $56.9 billion in net income in 2024. That's not revenue, that's profit. After every expense, every write-off, every regulatory fee, $56.9 billion in 1 year. But here's the thing nobody tells you about getting into this business. The money is the easy part. Before 2008, over 100 new banks were approved in the US every year, every single year, like clockwork. After 2008, that pipeline collapsed. From 2009 to 2013, the FDIC approved 7 new bank charters in total. Not 7 per year, 7 across 5 years, fewer than 2 per year. Since 2010, only 84 new banks have opened in the entire United States. That's an average of fewer than 6 a year in a country of 335 million people. Before the financial crisis, the lowest number of new banks approved in any single year going back to 1995 was 93. After the crisis, hitting 6 was considered a good year. The charter process alone takes 12 to 18 months minimum. Regulators review your business plan, your board, your management team, your capital structure. Then the FDIC has to approve your deposit insurance. Then state or federal chartering authorities sign off. Every step can stall. Some applicants spend years in the process and never get approved. One application was rejected because the organizers couldn't raise sufficient capital after spending years trying. The FDIC doesn't give that time back. Okay, you got your charter. Now how does the thing actually make money? The answer is 3 words: net interest margin. Here's how it works. You take a deposit from someone, let's say they put $100,000 in a savings account, and you pay them 2% interest a year. That's $2,000 you owe them. Then you lend that same $100,000 to someone else as a home loan at 6.5% interest. That's $6,500 coming in. The difference, $4,500, is yours. That spread, expressed as a percentage of all your earning assets, is your net interest margin, your NIM. A bank is a spread machine. That is the whole business. Here's where it gets interesting. The larger the bank, the thinner that spread. JP Morgan runs a NIM of around 2.5%. They're so big and diversified that their spread compresses. A community bank, one of those small-town lenders, runs a NIM of 3.5 to 4.5%. The industry average across all FDIC-insured institutions hit 3.39% in Q4 of 2025, the highest level since 2019. So small banks are actually better at the core business of banking than the giants. They're squeezing more profit per dollar than JP Morgan. The problem isn't the margin. The problem is the scale. A 4% NIM on $500 million in assets gets you $20 million a year. A 2.5% NIM on $4 trillion in assets gets you $100 billion. The spread is worse. The number is incomprehensible. Now here's the thing about NIM that took down some very smart people. It moves. The entire engine of your bank runs on the gap between what you earn on loans and what you pay on deposits. Interest rates go up, that gap can widen or compress depending on how your balance sheet is structured. Interest rates go down, same thing, different direction. You have no control over what the Federal Reserve decides to do. You just sit there and absorb it. Now, the costs. And this is where a bank is different from nearly every other business. The first hidden cost is regulatory compliance, and it is not cheap. A community bank with less than $1 billion in assets spends, on average, around 12 to 15% of its non-interest expenses just on compliance. Examiners, audits, reporting systems, lawyers, risk officers, and the dedicated staff whose entire job is to file the right paperwork to the right regulator at the right time. The bigger you get, the more layers of oversight. Once you cross $100 billion in assets, you enter a different regulatory tier entirely. You get stress tests, resolution planning, enhanced capital requirements, a small army of federal examiners who show up not just once a year, but continuously. The second cost is loan losses. You are in the business of lending money to people and companies who may not pay it back. Every year, some of them don't. You have to set aside a reserve, called a provision for credit losses, before you know exactly what you'll lose. Set too little and you're exposed. Set too much and it tanks your earnings. Community banks saw provision expenses rise 20% in 2024 alone. That's money carved out of profit before a single bad loan is confirmed. The third cost is one most people never think about: deposit insurance. Every FDIC-insured bank pays into the Deposit Insurance Fund, the pool that backstops depositors when a bank fails. The assessment rate varies by size and risk profile. The DF balance was $133.1 billion as of Q3 of 2024, and that entire fund gets replenished by the banks themselves through ongoing premiums. You're paying for the industry's failures, not just your own. And then there's the one nobody puts on the pitch deck: liquidity risk. The whole model of banking, borrowing short, lending long, means your deposits can leave faster than your loans come back. Most of the time, this doesn't matter. Deposits are sticky. People don't move their money until they do. Two failure patterns show up over and over again in banking. Every major collapse in recent history comes down to one of them. Mistake one: mismatching your assets and your liabilities and hoping interest rates cooperate. Meet Silicon Valley Bank, founded in 1983. By 2022, the 16th largest bank in America, $209 billion in assets, $175 billion in deposits. A favorite of the tech startup world, the bank had grown 25% per year for years, riding the venture capital boom. During COVID, money flooded in. Tech companies and startups were flush with VC cash, and they parked it at SVB. The bank needed somewhere to put all that money. So management started buying long-term US Treasury bonds and mortgage-backed securities. Safe assets, government-backed. Nothing could go wrong, except interest rates went up. The fastest rate hiking cycle in 4 decades. And when rates go up, the value of existing bonds goes down. SVB was sitting on unrealized losses of roughly $15.2 billion in its held-to-maturity bond portfolio and another $2.5 billion in available-for-sale securities by end of 2022. They could have weathered that, as long as they never had to sell. On March 8th, 2023, they announced they had sold $21 billion in bonds at a loss of $1.8 billion, and that they needed to raise $2.25 billion in new capital to plug the hole. The announcement was meant to reassure investors. It had the opposite effect. Peter Thiel's Founders Fund told its portfolio companies to pull their money. The message spread through group chats and Twitter in hours. On March 9th, customers tried to withdraw $42 billion, nearly 25% of the bank's total deposits, in a single day. The next morning's pending withdrawal requests were another $100 billion. March 10, 2023. Regulators shut it down. The second largest bank failure in US history. Took 44 hours. Mistake 2. Building for a market that stops existing when the rate environment changes. Meet First Republic Bank. San Francisco, founded 1985, grew to become the 14th largest bank in America. Their model was elegant on paper. Offer large mortgages at very low interest rates to high net worth clients, wealthy borrowers. Low default risk, premium service. The problem, they were giving out long-term low-rate loans right before interest rates went through the roof. Now they were stuck holding a portfolio of mispriced loans they couldn't get out of. Meanwhile, 67% of their deposits were uninsured, meaning accounts over the FDIC's $250,000 limit. When SVB collapsed and depositors everywhere got nervous, First Republic's wealthy clients, the exact demographic with more than $250,000 to move, panicked. First Republic failed in May 2023. JP Chase bought most of its assets. At the time, it was the second largest bank failure in US history. SVB held that record for about 7 weeks. In 2 months, the US banking industry managed to produce 3 of the 4 largest bank failures in its own history. First Republic at number 1, SVB at number 2, Signature Bank at number 3. The business model of banking didn't fail, the risk management did. So what do you actually make if you do this right? 2 scenarios, real numbers. Scenario 1, a community bank. You've raised $20 million in capital. You've survived the charter process. Your bank has $300 million in total assets after a few years of growth. At a net interest margin of 3.5%, you're generating around $10.5 million in net interest income per year. After all operational costs, compliance, provisioning, and the FDIC assessment, you're clearing somewhere between $2 and $4 million a year in net profit. Not bad. The payback period on your original $20 million is 5 to 10 years. Boring, recession-resistant, the most respected business in your town. Every civic ribbon cutting, every local sponsorship, every small business loan that keeps a diner open, that's you. Community banks account for 60% of all small business loans in America. You are the actual infrastructure of the local economy. Scenario 2, you do what Jamie Dimon did. Meet Jamie Dimon. He became CEO of JP Chase in 2006, just before the worst financial crisis in a generation. He didn't just survive 2008, he used it. Acquired Bear Stearns in March 2008 for $10 a share. Acquired Washington Mutual in September 2008. Added assets at crisis prices while competitors were falling apart. By 2024, JP Chase had $4.0 trillion in assets, revenue of $177.6 billion, and net income of $56.9 billion. A return on equity of 18%, the most profitable bank in the world. Every single day in 2024, JP Chase made roughly $155 million in net profit. On a slow day, and here is the single most important thing about banking that nobody says out loud. The bank doesn't need your money, it needs your deposits, because deposits are the raw material. The bigger your deposit base, the more you can lend. The more you can lend, the more spread you capture. The more spread you capture, the more capital you build. And the more capital you build, the more deposits you can attract. It's a machine that feeds itself. The only way to stop it is to panic the depositors. And the only way to panic the depositors is to give them a reason. Just don't give them a reason.